Hello, everyone. Thank you so much for coming to today's webinar, Investing 101. I apologize for the several minute delay here. We are just having some technical things this morning, but that's or I guess this afternoon. That's the type of day it's been. But thank you all so much for coming. We're going to get into the presentation presently here. Um, Today's presentation is going to be Investing 101. Just in case any of you hadn't heard yet, we have recently gone through a rebrand and a change. We are now the Harvard Federal Credit Union instead of the Harvard University Employees Credit Union, so a little bit less of a mouthful. And we have a new brand, a new name. We're very excited about all this. But of course, even with the change, we are still the same old community-focused credit union that you all know. Today's hosts are going to be me, Ty Robinson, and my coworker Terrence, who's going to be behind the scenes, kind of helping gather questions as they come in, dropping some links in the chat a little bit, as well as our manager Jen. And we're very happy today to bring you this topic. But before we begin, just a few housekeeping things about today's webinar. We are going to be doing this in webinar mode. I'm sure you're all used to Zoom at this point, but basically that just means everybody's automatically muted, everybody's automatically got their cameras off, so you can just like sit back, enjoy your lunch. This is also going to make sure that we reduce background noise. For today's presentation, we definitely encourage questions, but we are going to use the Q&A feature on Zoom for questions rather than the chat feature. This is just going to make sure that we can help gather them together a little bit more easily. And we're going to probably reserve all the questions until the end of today's webinar. We'll gather questions throughout the webinar itself, and then when we get to the end, we should have about 15 minutes for Q&A as well with Raj. So please do drop questions in as they come up throughout the presentation, and when we get towards the end there, we'll be able to answer them. And then the last thing is that this presentation is being recorded. This is just to make sure that we can add it to our YouTube page. So if you miss out on anything or you want to be able to go back and review it, you'll be able to find it for free on YouTube, as well as all of our other presentations that we have done, of which there are over 100. So definitely take a look at that when you get a chance. All right, but without further ado, let's talk a little bit about the credit union and why we're different from like some of the sort of bigger banks. Well, for a number of reasons. Oop, hang on. Okay, so credit unions we are community focused. We are a not-for-profit organization, which means that the profit that we do make, we are able to give back to our members and our community in many different ways. Some of those ways are we have better services, we have better rates on some products, we help make ATMs free as well. Nationwide, usually if an ATM would charge a fee, we are able to help refund that fee for you. So you can not have to worry about going to a specific branch or credit union ATM, and you can access us anywhere. We have convenient locations, online banking, mobile banking, that whole platform. But we also do have shared branching network with other credit unions, which is a really cool thing where you can access your account from our credit union or a different credit union at a different branch for a completely different credit union, because we all work together to make shared branching to make it so even though there's not quite as many locations as some of the other banks out there, you are able to access your accounts and stuff like that from other places. So anyway, that's a little bit about credit unions, but I'm sure you're all here for the investing presentation, and so we're going to jump into that with our presenter today, our expert here, Raj Banchali. He's our investment advisor representative here at Harvard FCU, and we are very welcome. We are very happy to have him here. All right, welcome, Raj.
Welcome, everyone. Thanks for having me. Terrence, hi, thank you. So I look forward to talking about Investing 101. I'm sure there'll be a lot of questions out there, so we look forward to that. But as we get into it, we just keep moving forward. So there's always our fun disclaimers that we have to share with you. This is basically whatever I say might be accurate, it might be right, but for legal purposes, just take it with a grain of salt and always consult someone with specific questions to your situation. So with that, why don't we just go ahead and jump into the presentation. So as Ty pointed out, we're going to talk about Investing 101. This is sort of the agenda we want to follow. If we were more in a live in-person type of situation, we'd probably take questions and things like that as we move along, but we're trying to stick to this agenda and then try to leave some time for questions at the end. But as I said, if you have any questions as we go through it, just drop it in the chat feature. But really what we want to do is talk about what securities trading is, investment goals and risks, fees and commissions, um, buying and selling strategies like that, evaluating performance, and so on. Because when you break it down, investing can be quite simple, but it's also very complicated, right? So that's why the more you know on your own, the better, and the more you know as you work with someone, even better. So as we go through, um, we get a lot of questions on like what securities are, right? So do I have control of the
Uh,
presentation?
no, I'll be in control of those slides.
Okay,
You
yeah,
just let me know when you need me to go to the next one,
yeah. So
and
we can
we'll
go ahead.
take care of
Yeah,
it.
we can go
We're
ahead.
winging it. Yeah.
Great. That's how we like to do it. So we can go to the next slide. And so, when it comes to investing, really anything can make up an investment portfolio, right? So what we're doing with investing is making sure that whatever you're putting money into today has value in the future, right? So, making a contribution to your 401k, making a contribution to IRA, those are, some more common types of investing. But, keeping money in a checking and savings account, that's a type of investment, right? Because you're holding money somewhere that um, you have liquidity, but at the same time, if you're going to sit on money for a long time, you're making the choice of losing value safely, right? And what I mean by that losing value is inflation sort of erodes from your purchasing power. So when we're looking to invest, we're looking at things that are going to appreciate in time, right? So a collection of investments, as I said, most common are stocks, bonds, but then right now, like CDs, certificate of deposits are good. People invest in art, people invest in cars. When I was a kid, I used to buy baseball cards, hoping that those would go up in value. Unfortunately, I didn't hit on the right ones, but those are types of things that you look at investment. But the most common way to invest for a majority of Americans is through stocks and bonds. And, not only do individuals own stocks and bonds, but corporations will also, governments will also. So again, what we're trying to do is making sure that today's dollar has value in the future. We can go on to the next slide. Yeah, so as we said, the most common forms of investing are stocks. And when you own stocks, you have, they're also known as equities, right? So stocks, you have direct ownership of a company, right? So I always use like Apple or Tesla as an example. So if you buy one share of Tesla or one share of Apple, you now become an owner of the company. So you share in whatever happens in that company's future. So if it does well and the stock goes up, you participate in that. If the company does poorly and the stock goes down, you participate in that. So you now are essentially an owner of whatever company stock you purchased. Bonds are also known as fixed income or debt securities. So what happens with a bond is you become a lender to that corporation or institution. So, and what that means is you let someone borrow money for X amount of years, and in turn they'll pay you a coupon or interest uh, based on that, whatever the current market rates, generally whatever the current rates are. And then when that security or that bond comes due, the maturity date, you'll get back your principal amount, and over time you've collected interest. So the most common example of that is like a U.S. Treasury bond, or you would you would find that like when we talk about the national debt and all that, what that is the U.S. government's borrowing money from people, right? So you can buy a bond, you can buy a U.S. Treasury bond for 5 years. Let's just say the coupon is 3.5%. So every 6 months, you'll get a payment of 3.5% based on the principal amount that you've put in. So usually bonds trade in thousands. So let's just say $1,000. So if you give them $1,000 for the next 5 years, you'll get a 3.5% payment every 6 months based on that $1,000. And then at the end of 5 years, you'll get back your $1,000. But over time, you've collected those interest payments or those coupon payments. That's why bonds are generally considered a little safer than equities, but they also um, limit your sort of upside um, as well as protect your downside. And then another form of security investing that most people are more common with are mutual funds or exchange traded products like ETFs and things like that. Most of you will have exposure if and when you start working in a 401k plan or a 403b plan. And most of those plans will carry either like a mutual fund or an ETF or an ETP portfolio. And what that does is you're sort of pooling your money with other investors. And what that does is it gives you a more diversified portfolio if you have limited amount of money to put to work. So, diversification is always a key. So like if you only had $500 to invest, it's hard to buy like one stock or one bond and expect to get great results. But if you have $500, you can put your money into a mutual fund, and then you have that kind of diversification that we always preach to have, because having um, that type of diversification is sort of like what we always say, you don't want to put all your eggs in one basket, because in case something happens, um, at least other levers are working while one thing isn't, right? So that's what you'll find with mutual funds and ETPs, things like that. Ty, we can go to the next slide. So, and then within like every portfolio, you're going to have asset allocation. And to break it down even further, you're going to have sector allocation. So again, asset allocation, stocks, bonds, cash-like assets, right? So when we talk about investments in the investment world, our investment professionals will always talk about like a 60-30, excuse me, a 60-40 portfolio or a 70-30 portfolio. What that means is the allocation of your investments. So like in a 70-30, 70% of your money is going into stocks, and then 30% of your money are going into bonds. And then some of it will be, so if you want to really break it down, it's probably more like 69-29, then 2% would go into cash or cash-like assets, right? So cash is very simple. Money that you keep in your checking or savings account, that's considered cash. Cash-like assets are like money market instruments, CDs, things like that. Things that are more short-term in nature, have a little bit more liquidity to them. And you want to use those as things that if you need to raise money right away, those are your portfolio. So um, what happens with stocks is over time, they tend to give you better returns. Um, but there's a lot of volatility with it. Like, so if you're measuring like in 2-3 months time, stocks will probably be more volatile than bonds would be. And then cash would be the least volatile of all those things, right? Cash like assets, because they kind of hold their value over the short term, but over the long term. So if you have a more long term focus, stocks will probably give you better returns than either bonds or cash like assets. So when you're investing, depending on your timeframes and your goals, you just want to have an idea of like what those are first, and then from there you determine like what your asset allocation would be within stocks, bonds, or cash like assets, right? And if you're not sure what that is, then that's when you want to consult with someone about like what a good mix is. But again, and we'll talk about this as we move forward, a lot of investing is really dependent on what your time frame and what your goals are. Because and you can have different pools of money doing different things at the same time. There's nothing wrong with that. But asset allocation really determines how successful you are with your investments. So we can go to the next slide. All right, how to get started? That's always a question everyone asks me, even if they've been doing it for 5 months or 5 years or 5 minutes. And so there's never a wrong time to start, but when you are trying to start into something like this, you wanna make sure you're going about it the right way. So, and we talked about this earlier. You want to set goals, right? So the important thing is to know like what you want your money to do for you, because depending on what that answer is, or what you need that money to do for you, you're going to have different ways to put money to work, right? So short, medium, long term. And when we think of like short term, we think in our world we say 0 to 3 years is more of a short term type of time frame. Mediums, 3 to 7 years, and then longer term would be 7 years plus, right? And when I say, kind of know what you want your money to do for you, like if you have a pool of funds, then in 6 months you're going to need that money, versus 6 years or 60 years, you're going to invest those funds differently, right? So one good example we come across here at the credit union is someone saving for a down payment on a house. So if they're saving for a down payment on a house because that's their most pressing goal in their future, if they're looking to buy a house in 6 months, well, then we'll say, you want to look at something that's a little bit more stable, probably not as volatile, and maybe will give you less of a return, but like in 6 months, when you need to make that initial down payment, that money will be available for you to do that. But if you say, you're looking to buy a house in 6 years, well, then we can talk about a different set of things to look at, like because that's a whole different circumstance, right? So if it's 6 years and maybe you don't want to put money in a short-term type of investment, if it's 6 years, you can take on a little bit more risk, hoping that the returns will be greater, and you can grow that pool of money more efficiently and better. Then if it's longer term, like if it's not 6 years, but maybe say 16 years, because you're just out of college, you're not sure what you're going to do, but you have a pool of money that eventually will go for a down payment. Well, then we can look at even other things that will probably make more sense. So again, setting those timeframes, knowing like what the money is done, what you need the money to do for you is very important. Just like with retirement, if you're not going to retire for 20 years, 30 years from now, your your investment profile will be different versus like if you're going to retire in 6 months from now. Um, because again, it's going to determine like what makes the most sense and how to invest. So understanding what you want the money to do for you and when, those are important. So that's the first thing you want to do is look at your time frames. You can go to the next slide. Yeah, so here, just going to repeat myself here. So knowing your time frames, right? So like I said, um, if it's 6 months, 6 years, 60 years, those are important things to know. Now, there's nothing wrong with changing things midstream along the way, but again, if you have a longer time frame, then it's easier to change course in the middle of it versus if it's a shorter time frame, right? So again, if you're planning to buy a house in 6 months or paying down some debts in 6 months, or going on a trip in 6 months, you want to try to stay a little bit more conservative and find things that are going to maybe be less volatile. But if you're saying 6 years from now, but along the way, year three into that 6 year plan, things change. You find a new job, so instead of waiting to find something in Cambridge that you'll like, you're moving to Texas, and now you have to buy a house, right? So those things can change, and there's nothing wrong with that. We can always adjust, but it's a lot different. Like I said, if it's 6 months, 6 years, or 60 years. So just having those timeframes in mind. Now, once you say that, doesn't mean you're locked in, but depending on the investment, you should be able to change things as you go, and that's what you want to do is making sure like you're reviewing what you're investing in, reviewing your goals, reviewing your timeframes, and if you are working with someone, talk to them about what's changed in your life, what's changed in the economy, what's changed in the sort of geopolitical climates and things like that. And that's how you're going to become successful in investing. But so again, knowing your timeframes and your goals are very important. We can go to the next slide. Yeah, and then also investing, I said earlier, anything's an investment, but once you start putting money into the markets, whatever those markets are, you want to be patient, right? So I can't tell you how many times I've put money to work for a client over the years, and 3 days later they're looking and say, well, I gave you X amount of dollars, and now we're only up, like maybe $2, $3, right? That's it's not going to work that way. You need time for these things to sort of marinate and work out, right? So again, that's why knowing your time frames, knowing what your goals are, helps, because if you are investing blindly and you don't know any of these things, like, and it turns out you want the money in 6 weeks, well, you know what? There's a good chance that your money invested in whatever portfolios are is probably going to be down. But if you're investing for longer terms, like I keep saying 6 years, but whatever that time frame is, but for longer terms, there's a good chance that over time those investments will work out. And if you ever pull up like a chart on the Dow Jones, the Nasdaq, the S&P 500, you'll see like over shorter periods they go up and down, but over the longer time, over the long haul, it continually goes up. There's always an upslope to those charts. There's a reason for that, right? So you just want to be patient. and the more time you give it, the better off you will be. But like, you don't want to act and react every time you check the markets versus checking your accounts and saying, well, I'm not doing anything. I need to get out of here. That's the wrong thing to do when it comes to investing. Now, investing and trading are two different things, but if you're an investor, you'll be patient. If you're a trader, you'll probably be less patient. Um, and I can tell you there's a big difference. So like, I'm an investor. I have an older brother who's a trader. So he reacts to every move in the market, and that's not good for him. It's not good for anyone. But you know, if you're investing over the long haul, just be patient. But if you're looking to trade, good luck with that. So, Ty, we can go to the next slide. Yeah, and then if you're new to investing, you just want to test things out, right? Like, so if you have a large chunk of money, you don't need to throw it all in at once, right? You can start building portfolios by taking little bites at a time. But also, if you're starting out, and I'm not just saying this because I'm an investment professional, but you should really want to work with someone, even if it's a small amount of money. You want to at least run ideas by someone. Most times we do work as fiduciaries. So, we'll tell you what's best for you. I will always tell you what the best solution is for your investment goals, right? But if you're not sure on what you're doing, there's nothing wrong with just taking little bites at a time and then building a portfolio that way, right? So like, if it's you know even if it's a large pool of money, and if you're not sure what you're doing, just to put a little bit in at a time, just so you get a feel of what it looks like. And it's like when you go swimming. If you've never gone swimming before, you don't want to jump into the deep end of the pool, especially if you don't know how to swim. You just want to like jump in, or at least go in on the shallow end and work your way out, right? Uh, but hopefully, if you're learning how to swim, you have someone there with you that knows, like a lifeguard or someone that knows how to help you if things go awry, right? So, but there's nothing wrong with testing waters, taking your time, learning a little bit about how the procedures are, like what it feels like to invest, and like just knowing what those outcomes are, right? So, again, and we'll keep harping back on knowing your goals, knowing your timeframes, being patient, and then if you test the waters, there's nothing wrong with that. We can go to the next slide. So another great way to get an investment portfolio started is through your employers. Most companies and um, uh, universities and things will offer either a 401k plan or a 403b plan. And what these plans are designed to do is help set you up for retirement. So what you'll do is you'll take money out of your current paycheck, invest it in either plan, either a 401k or a 403b or something similar, and that money will go right into that plan directly from your paycheck. Then also your employer will match up to X amount, right? So most times it's up to 3%. Some companies do up to 6%, but whatever it is, you're allowed to put X amount of dollars away into a retirement plan, and that's always good because most times it's money that you won't even miss coming out of your paycheck. And the nice thing is it comes out on a pre-tax basis. I can't give tax advice, but what it is it's really money that you're not even probably going to know you're missing, right? So, and it's a good way to start taking advantage of markets, and also taking advantage of what the employer offers you for benefits. And that's a good way to start investing, because again, the whole idea behind investing is to make sure that today's dollars continue to have value in the future, right? So, like with these retirement plans, most likely you're not going to have need for these funds for like 25, 30 years out, right? So again, the purchasing power over time erodes because of inflation. I always use the example of the 2 liter bottle of Coca-Cola. Back when I was in college, back in the 90s, I used to drink 3 2-liter bottles of Coke each week. And back then it would cost 99 cents for a 2 liter bottle plus the 5 cent deposit. So I knew every time I went to Stop and Shop or Shaw's, I would need $1.04, and I can buy my 1 2-liter bottle of Coke. Nowadays, you're lucky to get 1 2-liter bottle of Coke for $3. And what's changed? Not much. It's still 2 liters. It's still the same components that they put in when they were making it back, 20, 30 years ago. But inflation, cost of other things, all that has risen the price of Coke. So if I kept $1 in my pocket for 20 years, 30 years, I'd be lucky to buy a can of Coke now because a 2 liter bottle is probably $3. So that's exactly what you're looking to do when you're investing, especially over the long term, is to make sure that your future dollars have value. Um, so, and a good way to take advantage of that is taking advantage and monetizing your employee benefits. Yeah, next slide. And then, yeah, you do want to educate yourself. So like, you don't want to get to the point where you're doing things blindly. Like you want to have a general idea of like what makes sense. You know, you want to learn about asset allocation. You want to know what the fees are in each investment you're making. You want to know about diversification. You want to avoid talking to 1,000 people trying to figure out what they're doing because you're going to get 5,000 different answers. And everyone has a great idea of what to do when it comes to your money, but they probably don't know what to do when it comes to their money. But I have an uncle who'll tell me always, even though I'm in the industry, how he hit it big on one investment. Well, you know, half the time it's the same investment that he's been carrying for like the last 30 years. And he didn't really hit it big. It just happened to work out in his favor. But you want to avoid like hot tips and hunches or listening to what other people might tell you it's best for you. Um, but if you're not sure, reach out to someone who's in the industry. They'll be more than happy to work with you and walk you through things. But you should know a little bit, right? So you should know the difference between a mutual fund or an ETF. You should know the difference between all like a total return fund versus a sector fund. You should know like why target date fund makes sense in some cases, but doesn't make sense in other cases. Right? So just know a little bit. You don't have to be an expert, but at least know like what a stock is, what a bond is, kind of know what the fees are and what you're getting into, and then like what it means when we talk about timeframes and things like that, and then like how to position your portfolios. And then this is again asset allocation. I think is the key to how investments work. Um, you want to make sure you have the right diversification among sectors, like sector allocation, depending on the economy. Certain sectors will do better. There's been a lot of talk about recession the past few years, right? So if you think we're going to go into a recession, there's certain sectors that you don't want to invest in, like small caps and things like that. But again, it all depends on what you're looking to do, what your timeframes are. But also, you know, if you're someone who's risk averse, maybe you don't want to be in a very heavy late growth type of portfolio of stocks. You might want to have a little bit more uh, uh, bond exposure, fixed income exposure, or maybe having more like blue chip stocks, dividend paying stocks, things like that. So asset allocation is a big thing, and that's always going to change depending on what the economy is doing. So like if we do go into a recession, things that are like what we call consumer defensive, like things that are staples, right? So like um, food companies, beverage companies, things like that, things that people are going to buy all the time versus like sort of consumer discretionary like entertainment, things like that, right? So having that asset allocation, having um, like knowing what exposure for bonds or fixed income or cash makes sense. Those are always good to have or know about because those will determine how successful you are when it comes to investing. We can go to the next slide. And then you want to know about fees and commissions, right? So each advisor or each person that you talk to will have different structures. Um, if it's something you're comfortable on doing on your own, then most likely you probably don't want to pay a fee. So you want to find places where they don't charge commissions or fees. If it's something that you think you need help with, then yeah, there's nothing wrong with paying a fee and commission. Um, and most times out of none, especially in these types of markets, active management's better than passive management. And I'm happy to talk to anyone about that, but you just kind of want to know what those are. Like, doesn't mean you need to sort of be put off if someone says like they're going to charge you X amount of dollars to help you, but you should know what those fees are, what you're getting for those fees, or what those commissions are, what you're getting for those commissions. You just kind of don't want to be paying fees or a commission in some sort of set it and forget it type of investment. Also, if, like I said, if you are comfortable doing things on your own, then maybe it doesn't make sense to pay a fee or a commission, right? Because if you're going to do all the legwork and all the trading and all that, then like why pay someone else that money? Because fees and commissions will take away from your returns, right? So, but also like if someone seems like they're way out of whack when they're charging you a fee, like if the fee comes out to like 9 or 10% of what you're putting in, that seems a little ridiculous. I probably wouldn't want to be associated with that type of advisor. But generally between 1 and 2% is most common, depending on what you're looking to do. And then, like I said, if it's something that you're comfortable doing on your own, then why pay the fee? But and we can have a conversation about like the benefits of using someone as a professional versus doing it on your own, because things happen in the markets that you might not be able to react to or get ahead of and things like that. But it's important, and anyone worth their salt will always tell you what they're going to charge you. Next slide. Yeah, so automatic investing, dollar cost averaging, those are good things to do also, especially if you're putting smaller amounts of money, but it's not limited to smaller investments. Over time, if you keep adding money to portfolios, you're taking advantage of downturns, and if you keep adding money to your portfolios, even when the markets are at top, you're taking advantage of that too. So a good example of like automatic investing or dollar cost averaging are like your employer 401k plans or your IRAs, and things like that, where every year or every pay period you're putting money into investment. And a good example I have of that is like when I was in high school, I only had $20 a week to buy gas. So regardless of what the price of gasoline was, I would fill my tank with $20, and that's one way of like looking at dollar cost averaging. Back then, if a gallon of gas cost $1.50, with $20, I can get X amount of gallons. Maybe I get a full tank. If gas ran up to $2.50, I still only had that $20 because that's what my budget was. So maybe I don't get a full tank of gas, but it got me enough to get me to where I was the following week. So that's kind of how dollar cost averaging or automatic investing works. You're just putting a fixed amount in at certain periods, and whatever the markets are doing, that's what the markets are doing. But you're hoping, like again, over time, that's going to benefit you. Go to the next slide. All right.
Okay, thank you, Raj. Very good. That's a lot of information, but we're very glad that you were able to get through everything. So we're now in the questions section of the webinar. We haven't actually had any questions come in yet through the Q&A feature, just in case you guys, I'm not sure, Zoom updates sometimes, and it's not always easy to track down all of the various options and things. So on your webinar bar, there should, if you're not seeing the Q&A feature, if you click on the 3 dots with the more, it should say Q&A there with like the polls section, something like that. It might be different depending on view, but just in case anybody does have a question and wasn't able to track down the Q&A question and answer feature, then please do take a look now. But we do, yeah, Jen, actually, if you wouldn't mind, maybe we could ask some of the questions that were submitted ahead of time. I think that would be very helpful.
Hi, Raj. So we did have a number of people submit their questions ahead of time, and I'm just going to see how many we could get to of those, because we did get a lot, and I know you've covered some of them.
Sure.
We got a question: what are some investment strategies that offset tax liability?
Yeah. So again, I'm not a tax professional, so I can't really give tax advice. But yeah, depending on the amount of money and what your current tax situation is, municipal bonds are a good way. And if you're not sure what municipal bonds are, those are like states or municipalities like the city of Cambridge, Sometimes Harvard University falls into that category. Like the Commonwealth of Massachusetts, the town of Cambridge, the MBTA, all are examples of local municipalities that issue bonds. And what happens there, if you're a resident of the state that you're purchasing or investing bonds in, it's triple tax free. So people in higher tax brackets tend to benefit from that. So what that means is the interest that comes in is you're not taxed on a federal, state or local level. If you invest in municipalities that are outside of your local residence, like if you saw a New York bond or a New Jersey bond, then you pay federal taxes, or excuse me, you'll pay state taxes. You wouldn't pay federal taxes and things like that. But that's one way of looking at, it's more of an old school way of taking advantage of tax-free income. And another way is like, if you're not making contributions currently to your retirement plan, an IRA is a good way to do that, because now you're allowed to invest in or open a traditional IRA and use those monies that you contributed to an IRA as a tax deduction against your current year tax filing. Another way is a Roth IRA. Just remember with Roth IRAs, there are income limitations on that. And these are all just general things. If you have a specific situation, happy to talk about it. But what happens with a Roth IRA is you're putting in after-tax dollars into an investment portfolio. And again, retirement accounts are designed for longer term investing. So like if you don't plan on touching that money for 25, 30, 40 years, you can take whatever growth comes out of that Roth, and when you take a distribution, you won't pay taxes on that, because contributions in a Roth IRA are already taxed. So the distributions from that is tax-free, as opposed to like in an IRA or a 401k or a 403b plan. When you start taking those distributions, those would be taxed at your ordinary income, but you're hoping that when you are at that retirement age or at that retirement level, your tax bracket has gone down, right? So, so those are some quick and easy solutions for taxes. And then, there are more things that you can look at. Like insurance is one way to use, life insurance is one way to use an investment or an insurance product as a tax sort of offset and things like that. But those are things that, if you're interested in, you can always come talk to me, or you want to talk to a professional about, or at least consult with a tax professional and see what they think would be the most appropriate thing for your situation. But
Thank you. And I did just put into the chat, folks, how to reach Raj if you want to talk about your individual situation, because obviously these things are complicated. Raj, do you have any advice for a member who's interested in investing for retirement, but is low income? How should that member approach their needs?
yeah, so I mean that's always a tough thing, right? I firmly believe everyone should put some money aside for the future. What you want to do is you want to start talking about budgeting and, like, again, goal planning and things like that. But really what it is you want to kind of have an idea of what a part of the planning process is to know what your monthly expenses are, you know, whatever those numbers are, and then try to keep at least 3 to 6 months worth of expenses, depending on your situation, just in a liquid type of account. So either checking, savings, money markets, whatever that is, not really worrying about what those returns are. Only because, like, I call it a rainy day fund. Most people call it an emergency fund. But you want to have that money just in case something happens, right? Like, a couple months ago, I had to get brake pads for my car, right? So luckily, I had enough in a checking account to pull that money out of, right? You don't want to have that money tied up in an investment, because most likely, if you have to pull right away without planning out for it, there's a good chance the money's not going to be the same, right? So you want to talk about, what your budgeting is, what your planning looks like, what your liabilities are and things like that. Like if you have quite a bit of debt, like credit card debt. Like there's good debt and there's bad debt, like credit card debt, student debt, things like that. You don't want to start planning for investments because like you want to take care of those, especially those higher interest like credit cards and things like that first, right? And
Yeah.
then if you find that you're in a situation where you are saving, and even though it might be lower income, you can always come up with a plan. Like I'm happy to talk to people about that, but you're just kind of looking to put away what you can afford to put away, and then that's when we talk about what we covered earlier about timeframes and goals and things like that, right? But even if it's a small amount, um, like $100 a month or $1,000 a year, you can find mutual fund companies. We can work with people on that as well. That you can set up accounts and do things like that. And then that's another good way to do that. Automatic investing or dollar cost averaging into portfolios, like when you do excess cash, put
Yeah.
funds in that. But
I I
said,
can definitely testify that when I was early in my career, I was lower income. I was working in the nonprofit field and putting aside just small amounts. It did add up over time because I had time on my side a little bit, and so it did definitely give me a good baseline of savings as then I hit a higher earning point in my career. I am also going to put into the chat, folks, that if you do want help with budgeting, because Raj was kind of touching on some just basic aspects of budgeting, we do have access to free financial counseling through the credit union from our partner GreenPath. And I'm going to suggest that for people, particularly a member who asked that question. Um, so there's a question here that's a little bit particular, but maybe we could also just answer it more broadly, Raj.
mm,
This person is starting over again at age 40, which also I can identify with that. And this person is only able to save 500 a month. They think they're about 25 years from retirement. How do you figure out like what you'll end up having by the time you retire? What's a good way do you have a calculator you recommend or any of that?
yeah, and that's a question we get asked a lot because like I know like when you read periodicals or like The Economist or the op-ed piece in the Wall Street Journal or something, like everyone's always like, well, you need to have at least like $3 million before you retire, or you're not going to have a successful retirement, right? But a lot of it comes back to your individual situation. There's no like amount of money that's perfect, right? It really depends on what you think your lifestyle is going to be like in retirement, right? So I always use the example of my mother. She basically lives off her Social Security because she has no real big expenses. House is paid off. Her biggest concern is paying the property tax and things like that. She doesn't really do much other than maybe once in a while go out with friends and family for dinner and things like that. So she is one of the few people I know that actually saves money on Social Security. And because her lifestyle, again, doesn't require a whole lot of spending. Um, but then I have an uncle who lives out in Seattle. He and his wife, they always go to the hottest restaurants. They want to travel. They want to go to like every opening of a Broadway play um, in Washington and things like that. So he's constantly draining his Social Security down. He's constantly draining against his 401k plan and his pension plans. So he needs to stay invested at all times. And I can tell you, he probably had a good amount of money in his 401k when he retired. But again, his situation dictates that he needs to stay invested. He needs to keep growing those funds. So there's no real magic answer to that. People usually say you should have about 10 to 15 times your salary saved up. Um, but again, it all depends on what your lifestyle is going to be like in retirement. And some people do less in retirement. Some people's expenses go down in retirement because if you have kids, you're not worried about paying for college anymore as they get older, because hopefully they're done with school. You're not worried about raising them. My father used to joke that by raising me and my brother, we cost him a Mercedes Benz every year. Um, like those expenses start to go away. Hopefully your mortgage starts to lessen or goes away, right? So most people tend to have a better lifestyle in retirement because of those liabilities are gone. And then in some cases, people's lifestyles go up because they have more time now. to do things that they've always wanted to do, like travel around the world, buy a house on the Cape and things like that. So there's no real magic answer. You just kind of have to look at it on a case by case basis. But you should have an idea of what you want your lifestyle to look like in retirement. But in most cases, they say it have at least 10 to 15 times your annual salary, at least as a part of what you have.
Thank you, Raj. And we did get one live question in, should I maximize my 401k contribution?
If you can afford to, yes, because that's a great way to get that tax-free growth. So the benefit of having like a 401k or an IRA or a 403b plan, the U.S. government doesn't give people many opportunities to earn something tax-free. So having that growth over time, tax-free, that compounded growth is a very powerful thing. So if you can maximize and you're in that position, you certainly should. And also that's another way to sort of reduce your taxable income, right? And then you also get the benefit of the company match as well, right? But you don't want to start maxing out to sacrifice what you're trying to do in your daily life. So like when I first started out working, I put everything I had into my 401k plan, and then later I found out that, well, I need to pay, I still need to pay rent. I still need to pay for my car. I still need to buy food. So what was happening then, I was like, putting stuff on my credit card because I was putting money in my 401k. So I had to change that real quick. So like, you don't want to sacrifice your daily living and what you're trying to do in your daily life for retirement. So if it makes sense for you, you should, but if you're not sure, come talk to someone, come talk to me, we can figure it out.
Awesome, Raj. Thank you so much. All right, I think that's all of the questions we had today. So thank you all so much again for joining us on today's webinar. I do want to do a brief little information here. We love feedback here at the credit union. We're very community focused. We're very member focused. So on any and all webinars that we do, we like to provide a direct link to a survey that you can fill out anonymously, giving us information on how you think we did, how we can improve, stuff like that. We're always looking to make sure that we speak directly with our members and with the people that come to the webinars, and are always looking to find better ways to discuss these types of conversations. So please, if you have a moment, feel free to read the, excuse me, fill out the survey. We read each and every response and are very interested in the feedback. So thank you very much. And just in case you didn't know, we do have a branch in the Longwood Medical area. Please do feel free to stop by. It's at 435 Brookline Ave. Raj is there sometimes. You could meet with him there. Yeah, please feel free to stop by. If you're not a member, consider joining us. We have all sorts of great benefits as we talked about. And as always, keep in touch. We have Raj's email here, as well as our new branded website, and we have all of the social channels. As I mentioned, we have our YouTube page where we put all of our webinars that we do, like this conversation. We do ones about credit and budgeting, as we also mentioned. So please do, if there's any topics you're not quite sure about or you'd like to learn more about, take a look at the YouTube page and then keep an eye out for future webinars and presentations from us as well. So thank you all again so much for coming today, and please have a great rest of your day.
Thanks, everyone.
Thanks, Raj.
Thank you, Raj.